Weekly forecasting series video where we look at the major Forex pairs and the DXY just to give you some sort of aid you within your directional bias and analysis from a fundamentals and technical point of view. I do these videos every single week just to sort of give a documentation of what I am currently thinking within the markets, what I'm sort of seeing in price, just to help you guys have a better directional bias and maybe think about a few things. So starting this week's video off as we do on the DXY weekly chart. We do this every single week pretty much. And for the past couple of weeks, we've marked out this run on sell side liquidity and this displacement higher on a daily time frame. This shows a bit better the market maker buy model, which has actually been a run on sell side and then displacement fair value gap legs higher. Now, we're currently at a bit of a sticking point within price, to be honest. We've been trading this market maker buy model higher and higher and higher, with one of the targets that was marked out actually right here. And we tagged that target and we failed to close above that, and then we've had some sort of retracement leg, which in a standard market maker model I've pointed out towards EURUSD last week in my commentary, this OTE range right here. Within that, we marked this out right here, and it's currently, I sort of refined my stop loss a little bit, and this trading idea I got taken out of, which is completely fine. One of the big things I'm an advocate of is there's going to be losing trades. It's how you manage them, and it's how your account is actually after them. Over the past couple of weeks, if you watch the weekly forecasting series, we've been absolutely bang on with analysing the markets. We've had a beautiful run on sell side to make this market maker buy model on a daily time frame. So whether you're swing trading, whether you're intraday trading, you could have gained something from watching these, and this run right here was perfect. We marked out the initial consolidation. We knew that the FOMC meeting happened around here, and it just kind of delivered really, really nicely. We've been really in line with the markets. Now, we've had, to be honest with you, a bit of strength on euro compared to the dollar. We've been trying to trade higher dollar, and we also had a little bit of euro strength, which is shown through euro GBP, which has shown sort of heavy retracement on the euro, which has stopped me out of this idea. Now, this isn't a problem, but where we are in the month now, we are over halfway through November. You always want to make sure that you are thinking about the time element. So I posted something over on Instagram where I said basically, one of the things to think about within time and price is time of the month. Like what week are you on? What week are you in within the month that you're in? So we are over halfway through now, and the retracement has been pretty much from here. We've opened, made the low, and we've sort of displaced higher leaving fair value gaps, which is a telltale sign just to sort of ease with the now, after reviewing this idea we didn't deliver from here, just sort of take a bit of a slow down approach. You want to keep that frequency intact of not just keep on trading this idea. With saying that, the dollar index is still perfectly viable from this low to this high. However, I would be monitoring this now just with that euro strength and the DXY. And what I mean by I'd be monitoring this is, rather than just hitting an entry now with an idea that I had on euro already being proven, I want to see a bit more confirmation within the markets that we are going to deliver higher if I was to carry on that bias towards higher targets, which means I would be looking for previous day's highs to get taken rather than just hitting the range straight away. Now, with saying that, one thing to think about and consider is the fact that we are now in November, and we are over halfway through November. Now, if you look at seasonal tendencies, I don't know if I've mentioned this before, but a seasonal tendency is basically, if you look back at the historical data of a price chart, whether that be the DXY, the EURUSD, GBPUSD, USD CAD, previously and historically, they have repeating patterns of movements throughout the year. So, December and January always trade pretty consolidated, pretty slow price action, choppy, not much movement. And this is because the liquidity gets reduced, the open float within the market comes down, and heavy and big investors aren't looking to build new ideas and positions. The year is slowing down just as holiday season comes in, and the markets do reflect that. Now, as a trader, our job is to trade the expansion of a market. So in order to capitalize on movement, we need higher volatility within the market in order to give that outcome a more favorable probability of winning. So moving into December and January, I always look to keep my frequency a little bit lower, definitely towards first week of December, and I'm done and dusted for the month, really, to be honest. I do tend to swing trade now. I'm not really an intraday trader. I've done both. This time last year I was intraday trading, which was fine. However, I've just noticed that on a daily chart, I always trade when I'm looking at intraday trading. I want a bias for the day anyway, so I'm pretty much using what I learned from how to intraday trade and moving that across into the swing trading. I'm just entering on a higher time frame rather than scaling down the time frames to, say, a 15-minute just because of the time aspects and stuff. So we're saying that if I need a daily bias anyway, and I can't swing trade it because of that expansion, then why would an intraday chart be any clearer? You've got to be very careful and critical. You've got to be a critical thinker of what you're actually looking to achieve within the markets. If you are looking for intraday trades for small scalping movements in price, then you need an idea of where that day is going to go on a higher time frame. And if you don't have that on a higher time frame, then it's probably not worth trading, and it's definitely not worth putting any risk behind that. So, go and enjoy yourself. Make sure you are using the time wisely to learn more, reduce frequency, and sort of make sure that you can go into 2026 with a fresh mind and sort of look objectively at the markets rather than doing a lot of damage to any accounts that you may have built up and worked very hard on. As trading's one of them games where if you just it's totally performance based, and then you get knocked down if you perform badly. It's not something where you start off at 0, you go higher, and then you might go back down to 0. You can actually go negative, lose money, and all of that stuff. So you've got to make sure that you are trading favourable conditions in order to achieve a good outcome within this game. And just by solely focusing on time and trading times when liquidity is high and there's volatility within the market, you're going to give yourself a better chance. So logically take that better chance and wait. It's a patience game a lot of the time. So yeah, anyway, moving on from that sort of side note and teaching, the daily chart looks like it's conflicting. It's swept this previous month's high. We're in this OTE range. Do we go higher? Do we go lower? I'm not placing any money behind this trading idea. I just want to see where we go from here. Going on a weekly time frame, we do have an institutional order flow entry drill fair value gap waiting on standby. So we could trade higher, but again, we've had that sweep, so I'm just waiting to see what happens. On a monthly time frame, now we are over halfway through the month again, as I've always said. We swept this low, traded higher, swept this high, come back down lower. It's purely telltale signs that there's going to be a bit of chop in the market, so I do want to wait and just wait for more extra confirmation. Same with this. It's obviously inversely correlated, so we want to make sure that we aren't making, the DXY sort of needs to tell us, and we've already been through that. GBPUSD has been much weaker. However, again, if we do compare with the DXY, and we do know that the DXY is the measuring stick, then if there's going to be consolidation, we want to be careful with this as well. And sort of once the DXY is at a point where we are sort of waiting for price to move a bit more, to give us a bit more clues on what's going to happen, we want to make sure that we're slowing it down and not sort of jump into too many cross pairs for the sake of jumping in. We did mark out this OT, but it never came, it's all right. We traded higher. We got the idea correctly. However, notice this. If we have a look, go back to a daily time frame, take this drawings off, this fair value gap, this OT marked out was good. But if we go, so USD JPY obviously leads with the USD, so it should reflect the dollar's price action. if we see that, we've had a sweep on a previous month's high and we've been trading lower on the daily time frame, and a USD JPY has been trading higher and higher and higher, which shows that there's a cracking correlation within the markets. If we were trading good conditions where the charts move in a favourable, the markets move in a favourable way where we can trade expansions and sort of really gauge. We use intermarket analysis where you look at different charts, different pairs, in order to see effectively what you can trade and how easy those runs are going to happen. But with this moving down and USD JPY moving up, it just shows that there's something off within the markets at the minute that I don't want to be involved in. The most favourable markets to trade will be when these are moving in sync, whether that be Euro USD should be inversely correlated. So if dollar index goes up, USD should go down, GBPUSD should go down, USD JPY should go up, and so and so. So when this is showing strength, this is showing strength as well. This is moving different to that chart. USD JPY is making new highs, whereas DXY is going lower and retracing. It's not a market where I'm looking at it and being sold the idea of a trading idea and want to put money behind that and sort of trade in a way that suits my model. Looking at the bond yield, US 10 years. Again, it's been a bit choppy, to be honest. We're sort of back and forth within this range. I'm just taking a lot of these drawings off from a lot of the commentaries we've done, marking that from high to low. We're range bound, to be honest. Or do we make new highs? Do we come down lower in the range? We're getting to that point of the year where expansion isn't too likely. So, we might be able to find a couple of trades by the end of the year, but I definitely would reduce expectations now and be building my sights on reflecting on my journal, reflecting on some of the data I've collected, looking at the model, seeing if there's anything I can do differently, and judging it from there, really. The last thing I want to mention is that the government shutdown has now apparently ended, supposedly. So we should be getting the data reports, which was news actually that come out this week, the week just gone actually, sorry. And that will be good to see the inflationary data and the jobs data. We've been going on this since all of the commentaries that I've been, since I started. Been quite conflicting within the dollar index. Is price, do we have rate cuts? Don't we have rate cuts? What's the Fed going to do with the rates? We need to see if inflation's gotten cooled off a bit with the rate cut, or we need to see if the job market is still elevated unemployment and stuff. So if we do get those data points, expect volatility. However, we haven't had data for so long that we want to wait and sit on our hands before we start jumping to conclusions. The one of the main things I've learned from looking back at a lot of the journaling stuff I've done is that the data really drives decisions. It's not short-term speculation. We've seen Trump cut tariffs and then take tariffs off and then put tariffs back on, and we see the market jump up and down. And we had it with the S&P 500 here. We had a big tariff announcement here, and I see all the news online. S&P is going to bleed. We're going to go lower. This could be horrendous. Bitcoin was a horrendous drop on that day. It was a Friday, because that was, I believe, Trump said he was going to put some tariffs on China, which, didn't actually end up happening. And there was negotiations, and then we just made all-time highs again. So it just proves, follow the data, be very careful of speculation, always look to trade the data, not the idea. And then you'll sort of be able to capitalise a bit better. So not too much, to be honest. I'm sat on my hands. I want to see the data that comes out in the next week. It might be boring. It might not be exciting to have a trade, but we've had a lot of trading opportunity over the past couple of weeks, and it's very normal to sort of reset, have a week off, look at the charts, ensure that what I'm looking at as a higher dollar, is it still viable? Is it going to show signs that it's struggling and being consolidative? And that's completely fine if it is. The market does not care what I want to happen. It cares about itself, and it's gonna reflect that with the chart. So I'm just purely watching as an observer at the minute, as I want more data before I put ideas behind. And I suggest you sort of reflect on your own trading model, and if you see something cool, that's you stick by that. But if you're making a decision that could impact your performance and could actually hurt you rather than put you in a better position and your account in a better position, then just take that into consideration. So with that being said, thank you for watching and have a safe week's trading.